Let's calculate the stock price for Merck. First, we need the market cap, which is 206.1 billion. Next, we need the share price, which is 81.68. Now we know the shares outstanding because it's the market cap divided by the stock price, 2.5 billion shares outstanding. What we're going to do is estimate the future free cash flows for a company and then discount that dollar amount back to today's values. Now that gives us the value for the entire company. And we take that number and divide it by the shares outstanding. Now we have the intrinsic stock price. And we're going to compare it to the actual stock price to see if it's higher or lower. And that's how you value a company. So to get started, we need the free cash flows, which is in the financial section in Yahoo under cash flow and the free cash flow. That's the cash that's left over after an operating period. So after running your business, this is the remaining cash. Net income is on the income statement. We need that next. We don't forecast net income because net income has a lot of other things involved, which are more accounting issues like depreciation. So you can't really forecast net income because you won't get as good as an indicator as free cash flow. Because you could have negative income one year and still do really well. Your business could do really well. And then you could have positive income, what seems like really high profit one year, but your business does very poorly. I know it's hard to understand, but it's all about accounting. So let's look at the numbers. Free cash flow, it jumps around as it usually does because some years there could be a big investment of a building or products or something like that. That could bring down cash flow. In other years, they might not have that one-time investment. Net income, it looks like it jumps nicely 2018, 2019, which is a good sign. And revenue is usually smoothest. It has a nice steady increase each year. So numbers look pretty good as long as there's no negatives. Once there's a negative in there, it makes it really hard to value, and then I have to kind of adjust the model but this looks pretty good. So now let's look at the capital structure of Merck to see what discount rate we need to apply to the future cash flows. So the interest they pay on their debt is $893 million. And let's see how much debt they have. We'll go to the balance sheet, liabilities, and the current debt is $3.6 billion. That's debt due within 12 months. And then long-term debt is $22 billion. That's debt due after 12 months. So they pay 3.4% interest on the debt. Interest payments are tax deductible. So let's find out their effective tax rate. We'll go to the income statement. Income before tax. And now income tax. 15%. So the cost of debt is 2.9%. And they have 11% debt in their capital structure, which isn't too bad. You generally want low debt. So that's not too high. Let's figure out the cost of equity. We need the beta for that. And they have a really low beta, 0.51. That's the volatility of the stock. So the cost of equity is only 6.24%. Which is higher than the cost of debt, 2.9%. Equity is a little riskier because if there's a default, debt holders are paid before equity holders. And the WACC, the weighted average cost of capital, is a blend of the equity and the debt. And that's 5.86%. And that's what we're going to discount the future cash flows by. So we calculated the future free cash flows for 4 years. Then we did a terminal value all years past year 4. Then we discounted those numbers back to today's values, and we get a value of the company of $282 billion. When you divide that by 2.5 billion shares, you get an intrinsic stock price of $112, which means it's trading at a 27% discount because it's trading at $82. So it looks like it's always been trading at a discount. And the reason people may want to pay more for a company that's what it's worth is because they see the future of the company being pretty valuable. And the reason people pay less than a company's worth is they may see the value of the company is not as great as the future. So Merck's case, people aren't interested in paying $112. They want to pay a discount because they don't feel maybe the future is worth $112. That's what the market is indicating. So now it's our job as analysts to look at it and say, well, based on the cash flows, it's worth $112. But how is the future of the company? How are they their competitors looking? And there's a lot of things you need to analyze and look at. But this is my analysis on it, and it's my model. So I hope you liked it, and thanks for watching.